Hey everybody, this is Gregg Gossett from Gossett Trading and Mentoring, and today is Saturday, March 11th, 2023, and I appreciate you coming by and taking a look at this week's review of all the trades that I entered and managed last week. Hope you're doing well. It was a pretty crazy week in the markets, big down week. Kind of a frustrating week, but these are the kind of markets we have in trading. They're going to be like this sometimes, and if you, want to be a professional trader, uh, we have to deal with them. So we have to take the good with the bad. So hope you're having a good weekend. Hope you stayed safe last week in the market. And today, the format for the podcast is, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back, take a look at all the positions that I entered last week and managed last week. We're going to talk about when I bought them, why I bought them, and most importantly, how I am going to manage them going forward. After that, we are going to do a segment on trader psychology. Always the most important skill in trading is the ability to create a plan and follow your plan without the emotions of the market getting you off of your game and getting you off of your plan. It really is important, everyone, that you follow your plan without letting your emotions get amplified. So I always like to talk about trader psychology. It's helpful for me to talk about it, and I hope it is also helpful for you. After that, we're going to do a quick poem from the trading poet Frank, my good friend. Always pertinent, good information, great poems every day. And so we'll do that. And then I have gone down through my master watch list. I am looking. I looked both on the dailies and the weeklies for some potential trades next week. Usually, stock has to go down, find some support, has to go up, find some momentum. Before I'm interested in it, I like to look for confluences, combinations of indicators lining up, ideally on multiple time frames. Very important. So I have gone down through the dailies and the weeklies, and I will show you what I am looking for next week. It's always helpful for me, and I hope it's going to be helpful for you as well. So first of all, I have to run the U.S. legal disclaimer, and I will be back in about 40 seconds. So hang tight. Thank you so much.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, well, let's get started on last week's positions, how I managed them, and let's start out with the Qs. Okay, now, of course, we had a big sell-off last week, kind of started by the Silicon Valley Bank situation, put a lot of fear into the market, and I believe that's why we had the move down. But, with moves down, there are opportunities, and we are coming into some levels that I really like. I really like deep dip buys. I really like buying when there's fear in the market, as long as I have a level of support that makes sense, ideally on multiple time frames. Qs. I did buy Qs back on the 24th of February with the bounce at the 200. This is a deep dip buy strategy. I did go ahead and buy, let's see, 290.77, and my end of day stop was simply a close below the 200-day moving average. Of course, I have my emergency stop down here as always, and as we get further into the podcast on some new positions that I took on Friday, I'll show you exactly how I set those, exactly how I position size, exactly where, so I know exactly how many shares to buy based upon my maximum allowed loss and where that level is going to be. But whenever I get into a trade, I look for support at some kind of major level, whether that's the 200 moving average, the 250, the 300, or the 30 RSI level. These are called deep dip buys. Now, a lot of these stocks have been, or a lot of positions that I've had this week have been deep dip buy positions. Now, I'll go through, I'll show you how I manage this trade. There are a lot of rules here. It's not difficult, but there are a lot of rules. I've been trading for 28 years, and the majority of my research has been focused upon managing the trade. I think that's the difference between a profitable trader and an unprofitable trader, is how you manage the trade always. I like to play offense and defense. Stops, end of day stops, emergency stops, those are defensive moves. Trailing stops, those are defensive moves. But I also like to take partial profits when the market gives them to me. Not all, but just a small percentage of my position as it moves up. So if the market turns back down like it does this week, at least I have locked in some profits at profitable levels. And most importantly, I mitigate the loss if the market turned down like it did this week. So this is a good example. This week is a good example when I show you how I've managed these positions and taken profits on the way out, how that really saved me and helped mitigate a lot of losses. Now, in the podcast, I do my best to show you these, but it takes some time. It takes some time and some repetition to learn these, and that's why I just want to let you know I do teach private one-on-one lessons in the evening time via Skype. I love to teach. I'm a great teacher, if I can say so myself. At least that's what my students tell me. And I teach the 5 different trading approaches that I use. A lot of these today are going to be deep dip buy strategies, but I also trade and use 4 other ones. And in my one-on-one course, I teach you step by step. It's a 15-hour course, 5 sessions. Each session is 3 hours. It's a serious course, but I show you exactly the rules. I make you show me that you know the rules, and the course is great. If you want to learn how to trade using good trading principles and with someone that has traded for 28 years and obsessed with trading like I am, then consider sending me an email. Email's in the link in the description, and we can talk about it. But it's a great course. It's worth every penny, and I'm sure you'll be happy if you took the course. So anyway, bought Qs with a bounce at the 200-day moving average back on the 24th of February. I bought at 290.77. I position sized using using my maximum allowed loss, using emergency stop down here, but my end of day stop is simply a close below the 200-day moving average. And as I just mentioned, as it moves up, I take partial profits. So bought here at 290.77, moved up, took some partial profits as it moved up, came down, went below the 200-day moving average. But of course, I use the closing price of the day to make my decisions. I believe that the end of day price is the most valid price of the day. You have the large financial institutions make a lot of their moves at the end of the day. And so I always go with the closing price as my actionable event. So on the second here, we opened way below the 200. I was like, oh boy, but we closed back above. So it kept the support level of my end of day stop, which is the 200. Next day up, had a beautiful day up, took some more profits up. Next day, moved up again, hit some right at the high. But you see how important it is to take partial profits when the market gives them to you. Now, orange line up here, 1.5 ATRs above my entry. Whenever I get in 1.5 ATRs above my entry, then I go into what's called trailing stop mode. That is a defensive move. And just because I get there doesn't mean I do anything, but it sets the stage for if I then have a close below a previous bar's low, I get out of half. Well, the next day it happened. Got to trailing stop level, had a close below the previous bar's low, got out of half of the remaining position for a profit of approximately 1.82%, which not a lot, but in the big scheme of things, it really paid off because you see, I took profits here, I took profits here, I took profits here. Then when we had a close below the previous bar's low after reaching trailing stop level, locked in half of the position there at 296.40. Next day, tried to go up, reversed, and then on Friday, we finally lost the 200-day moving average out of the entire trade. So ended up losing 0.77% on the trade. Not too bad, but not really, because I took partial profits here, took partial profits here, took half of the entire position off of here. So all in all, this was probably a positive trade because of the partial profits, because of locking in half here with a close below the previous bar's low after reaching trailing stop level. So I had a lot fewer shares on the way back down here. So that's what I teach in my course, all these rules. If the market keeps going up and you're scaling out and it just keeps moving up, are you still happy? I'm still happy. If I sell half here and it keeps going up, hey, I'm glad that I still have half. If it moves down, I'm happy that I sold half. Taking half profits when your signals tell you to is one of the only win-win scenarios in trading. Not a lot of them, but in this it is a win-win, because if I sell half and it keeps moving up, well, I'm still happy I have half. If I sold half and it moves down, I am really glad that I sold half. So this is the end of the Q trade. Ended up losing on the remaining shares 0.77%. Gold, oh boy, frustrating. Super, super frustrating. But again, rules made this a profitable trade. I bought gold back here on the 27th of February with an under 30, over 30. No, I'm sorry, with an under 300, over 300 deep dip buy. This is a deep dip buy strategy. Bought here, 168.90. Now, I'm sorry, under 30, over 30. It was under 30, over 30. Excuse me. A lot of positions. Under 30, over 30. Entered here 168.90. Moved up the next day, took partial profits, as I just mentioned. Next day moved up again, took partial profits. Next day moved sideways, nothing. Next day moved up again, hit 2 profit targets, but I did get to my 1.5 ATR trailing stop level. Now, I was just telling you about rules. With an under 30, over 30, the rules are as follows. As it moves up, I take partial profits. If it gets to trailing stop level using an under 30, over 30, if it ever gets back to my entry position, I get out at break even. And that's exactly what happened here on the 7th of March. Under 30, over 30, got to trailing stop level, took profits off along the way. But with an under 30, over 30, if I get to trailing stop level and it comes back to my entry, I get out on the balance at break even, which is exactly what I did. So was it still a profitable trade? It was, because of the offensive move of taking partial profits on the move up. So got to 1.5 ATR trailing stop level, came back, entry, got out, and then super rude just took off again without me. But that's the thing about your rules. Sometimes they are going to help you. Sometimes they are going to hurt you. And you're going to like, what did I use these stupid rules for? Well, you use these stupid rules. If it had just kept going back down, that would not have been fun. So sometimes they work for you. Sometimes they work against you. But in the big picture, they always net work for you. So got out here at break even, but still a profitable trade. And then it just took off rocketing without me, but that's just how it goes. But still profitable trade on gold. XLV, well, here's a good example of the rules helping. I did buy XLV back on the 1st of March with an under 30, over 30. Got long 126.88, moved up, took profits, moved up, took profits. Got to 1.5 ATR trailing stop level. And remember, with an under 30, over 30, if you get to 1.5 ATR trailing stop level and it comes back to your entry point, get out at break even on the remaining shares. So I got out on the remaining shares, got out at break even, but still a profitable trade, everyone, because of the partial profits here, because of the partial profits here. Now, was in this situation, it was a great idea that I got out at break even, because if I would have held, you see, it just went down and down and down. So gold, profitable trade. Actually, Q's profitable trade because of how I manage the trade. Gold, profitable trade because of how I manage the trade. XLV, profitable trade, again, because of the rules that I use. And this one really helped out because this one really went down. So out of XLV, Microsoft, kind of a bummer trade here, but most longs did not work this week. I did buy Microsoft here on the 8th of March. We went above the 200-day moving average. We pulled back. We bounced at the 200-day moving average. This is called a higher low rejection of the 200-day. Really like these trades. Got in at 253.40. Placed my emergency stop, of course, position size, placed my emergency stops 2 ATRs below, and my end of day stop was simply a close below the 200. Next day, moved up, did take some profits, thankfully, on the way up here. Did hit 2 profit targets on this day, so I took off 20% of the trade, locked that in. Market can't take that away from me. Came down, did hold the end of day stop of the 200, so I stayed in the trade. But then Friday, of course, we had a big move down, closed underneath the 200-day moving average with a loss of 1.9%. But again, net, it was really less than that because of the profits. Taking partial profits when the market gives it to you, in my opinion, is one of the most important things you can do. And again, in my one-on-one course, this is exactly what I teach. And so this tough week, but it's a great week for showing the importance of scaling out, having your rules. There couldn't be a better week to show you this. So on the remaining shares on Microsoft, had a loss of 1.9%. Okay, Goldman Sachs. Well, of course, the banking sector on Friday really got rocked with the SVB, and whether there's some contagion happening in the financial sector. Here is Goldman Sachs. Super scary to buy here, right? Really, really scary to buy. This is a deep dip buy setup that I'm going to be showing you here. And I did buy this on Friday at 327.67. Now, why did I buy this here? It looks like a crazy person would buy there. Well, possibly, but it did create a signal for me. The signal was an intraday. It was under 30 RSI and closed back over. There were not enough sellers to keep this under the 30 RSI. It's at 30.10. It's a very good risk to reward ratio. So let me explain how I position size and everything on this trade. So once I saw my signal of an under 30 over 30, I go, okay, I like it. I'm going to take the trade. Now, how many shares do I buy? Well, that has everything to do with how much money you have. So let's just say you have a trading account of $100,000. The rules that I use, take whatever your trading account capital is. If it's $500,000, 1% is $5,000. If you have $100,000, 1% is $1,000, right? If you have $50,000, 1% is $500. So 1% of whatever the total capital is, let's just say $100,000, 1% is $1,000. I take $1,000 in this case, divide it by the value of the 2 ATR. The value of the 2 ATR is 1610. This is 2 times the average daily range. I take that $1,000, I divide it by 1610. That shows me I buy 62 shares. Okay, now after I know how many shares I'm going to buy, I have to go, where is my emergency stop? Emergency stop is the level where no matter what time of the day or the week or the monthly chart, whatever you're trading, you go ahead and get out. So I know I buy 62 shares, and then I place my emergency stop exactly $16.10 below, right? That's basically 2 standard deviations. I place it below. If 62 shares moves $16.10, how much do I lose? $1,000, right? Because we just did the math. Now, again, I wait till the end of the day or the end of the week or the end of the month, depending what time frame I'm using, to make my end of bar decisions. But if it ever gets to my emergency stop, I get out immediately. I do not wait till the end of the day. So essentially on Monday, if Goldman Sachs, in this scenario, goes down $16.10 below, gets to 311.60, I am going to lose $1,000. Now, most of the time, that's not going to happen. Only about 5% of the time is that going to happen. The other 95% of your losses are going to be end of bar losses. Remember when I said that you wait until the end of the day to make the decision. So I enter this position with an under 30 over 30 RSI. If Monday it goes down and closes under 30 RSI, I get out, hopefully for a small loss. If it just goes rocking back down to my emergency stop, well, then I get out, and how much have I lost? In the worst case scenario, $1,000. right? So that's the end of day stop. It's going to be a close under the 30 RSI. Emergency stops down here, 2 ATRs from my entry. So those are all risk situations first. To the reward side, if the orange line here, this is 1.5 ATRs above my entry. Once I get to there, if I get to there, then I go into trailing stop mode, right? Which means in the future now, if I get a close below a previous bar's low, I get out of half like I showed you on Qs and some of the other positions. So that's how I position size. Regardless of what happens here, I know exactly what I'm going to do. I position size correctly, place my emergency stop. If it gets to my emergency stop, I know how much I'm going to lose. If it closes below the 30 RSI, that's my end of day stop. I get out. If it moves up on Monday, I'm going to place my 3 profit targets like I always do every day, so that if it moves up in profitable levels, I will take a portion off so we can lock it in. Market can't take it away from me. And if it does have a reversal after that, I have fewer shares and it mitigates the loss. So this is what's going. This is my new trade on Goldman Sachs, and don't know what's going to happen, but I know exactly what I'm going to do, regardless of whether it goes up or it goes down. And that's what you have to have, everyone. You have to have a plan in place. If-then statements. If it does this, then I'm going to do that. If it does that, then I'm going to do this. And that is what's important in trading, is having a full trading plan, position sizing correctly, end of day stops, emergency stops, partial profits, overhead resistance level, a trailing stop methodology. There's a lot to trading, right? And this, again, this is what I teach in my one-on-one course. I teach you all these rules, and you're going to know them all. I'm not going to let you go as a student until I know 100% that you have this ingrained in your head and you know what you're doing. So that's Goldman Sachs that's the new trade I took on Friday, excuse me. Now let's go over to the weekly bars. I like to trade multiple time frames. I trade monthly bars, I trade weekly bars, I trade daily bars, I trade I day trade intraday. I think it's important to trade as many different time frames as possible. I think it's important to trade as many different markets as possible, and as many different type of strategies as possible. Like I mentioned, I trade 5, and so that's why I like to trade intraday, daily, weekly, monthly bars, and I really like weekly bars. Actually, weekly setups have been some of the biggest gainers I've had in my trading career. Okay, QLD, I did short, thankfully. I did short QLD on the 3rd of February, near the very highs of the market. Why? Because we went up, rejected the 200-week moving average. I got short here at 46.10. Now, so this is the opposite. I position size. I place my emergency stop 2 ATRs above because it's a short. If it closes above the 200-week moving average, that would be my end of week stop. Place my 1.5 trailing ATR stop level down here, almost there. Then I'll go into trailing stop mode. And then, of course, as it moves down, I take partial profits as well. So shorted here, 46.10. Next week went down, took some profits off. Next week didn't go down, no profit taking. Next week went down, covered some more. Next week went up, no profit targets there. This week, big profit target week to the downside. So, and almost a trailing stop level. So far, this particular trade on the shares that I have remaining up 14.4% because I'm short. And I like to have the balance, have a lot of long positions, but I like to have the balance of having some long and some shorts as a hedge. And obviously, really grateful that I did that. So this trade up 14.4% on the short. SSO, okay. Bought SSO back here on the 6th of January at 45.60. Why did I buy it? Well, the deep dip buy signal was a close under 200, back over 200. Position size, place my emergency stop down here. Where's my end of week stop? Just a close below the 200-day moving average. That's it. Placed the trade, moved up the next week, took some nice profits off while the market was going up. Next week didn't do anything. Next week up again. Took more profits while I had them. Next week, up again, took some more profits, locked them in, but more importantly, got to my 1.5 ATR trailing stop level. So now I go into trailing stop mode. Was there a close below this low? No. Was there a close below this low? No. The next week closed below the previous bar's low after reaching trailing stop level. Got out here at 47.46 with half of the position for a profit of, looks like, about 4.25%. Next week, moved up, hit one more profit target before the big move down. Friday, it closed below the 200-week moving average. Had to get out, but keep in mind the importance of taking profits as it moved up. That mitigated a huge amount of the loss. Having a trailing stop methodology where I get out of half after I get to trailing stop level. That saved a lot of money, right? And then one more profit target last week, thankfully, before it came back down. So on the remaining shares here, lost 2.34%, but not even close to that. As a matter of fact, with all the profit taking that I took here and the trailing stop level, very likely this was closer to a break-even trade. So just want to show you the importance of having a process, taking profits when you have them, having trailing stop levels, having a process, because on a week like today, on last week, it mitigated a ton of loss. And it's a good example of why I teach this process, why I use this process. So out of the trade here with the remaining shares with a close below the 200-week moving average. SSO. Well, I have been in SSO for a long time. I bought IWM. Deep dip buy. Intra-week rejection of the 300-week moving average. Got long 167.19. Place my emergency stop, 2 ATRs below. End of day stop or end of week stop, just a close below the 300. Okay, hasn't happened yet. Moved up, took profits. Moved up, took profits. Here to here, moved up, took profits. Got to trailing stop level. Then had my first close below the previous bar's low. Got out at 178.70 on that first half for a gain of 6.41%. Continued to move back up, took off more profits here, took off more profits here, obviously took off more profits here, right? And then we had the downward move. Already had a first close below the previous bar's low over here. That only happens twice. Once the first time you reach trailing stop level. Second, if you have a close below previous bar's low after reaching 70-hour side level, but that has not happened yet. So it's irrelevant. But again, all the rules that I teach in my one-on-one course. Did not have to take any action on this on Friday. It was a huge week down, but close below the 300-week moving average. That is when I would get out of the rest of the trade. If it keeps moving up from here, of course, I'll take more profits. But the remaining shares that I have on IWM still up 5.14% even after the big move down. KMX, all right. This is a different trading approach. This is called a higher low V1, V1s, V2s, very important in my trading. And by the way, I teach this in my one-on-one course. Obviously, we go through it for hours and hours and hours. But if you like, I do have a YouTube channel, Gossett Trading and Mentoring, that you're watching right now. But in that YouTube channel, there is a lessons playlist, and I have a nice video in there that describes V1s, V2s, totally free. So feel free to go over, check that out. I believe I have a link in the description here. I've had many people that said that was very, very helpful. But a V1, V2, a V1 consists of two bars, bar 1, bar 2. If bar 1 goes if bar 2 goes below the low of bar 1's low and then closes above the high of bar 1's close, that is the entry signal. Got long here at 65.40. Of course, I place my emergency stop 2 ATRs below like I do with each trade. And my end of day stop is simply a close below halfway of the washout bar. This is bar number 2 in the washout bar. I know it sounds confusing. Watch the V1, V2 video. It's really not that confusing, but you can see the pink line here is halfway. If I close below halfway, that is my entry. Now, because this is a higher low V1, V2, there are some other rules in here. So got long 65.40 next week, moved up took some nice profits. Next week had a huge move up, took lots of profits off, and got to trailing stop level. Now, if I have a higher low V1, V2, the rules are as follows. If I have a higher low V1, V2, if it gets to trailing stop level, then if it ever gets back to my entry point, then I get out. Same with the rules of the under 30, over 30 that I showed you on gold and XLV. So the reason I do this, under 30, over 30s, they tend to bounce a lot and then come back. That's why I use that rule. On the higher low V1s, V2s, I also use that rule because I mean, this trade was up like 17% at one point, and I'm just not going to let that turn into a loss. So higher low V1, entered, took profits the next week, took lots of profits the next week, thankfully. But this week, it got back to my entry point after reaching trailing stop level. So I just got out of the remaining shares after taking profits at break even. So I think this is a good example of why these rules work. They really work, and they make trading a lot easier. You know, like I said, I've been trading for 28 years, and the majority of my research has come about how to manage the trades. And good thing I did, right? It was a profitable trade. If I would have just held on to it, no, it would have been a negative trade, but it was a positive trade because of the partial profits, big profits here, and then, I am sorry. I forgot to mention this. Once we got to trailing stop level, then we had our first close below the previous bar's low. Can't believe I forgot that I didn't see it. So I took off even more with a profit of 10.82%. So higher low V1, offensive profits on the way up, offensive profits on the way up, got to trailing stop level, then had first close below the previous bar's low. That's why I have the dotted line here. And so I locked in half with a 10.82% gain. Good thing I did, right? Because now look, so whatever I had remaining after that, once it got to trailing stop level, then I got out. So beautiful, wonderful, profitable trade because of the partial profits, because of the trailing stop rules. And had I not used those, well, yeah, I would have gotten out here and I would just be completely out and a loss on the trade. But by using them, nice, beautiful, profitable trade on KMX. Okay, WBA. Well, this was a bummer. This is a different approach that I use. This is called a return to value V2. You know, I use V1s, V2s. V2s consist of V1s consist of 2 bars. V2s consist of 3 bars. Here is bar 1. Bar 2 goes below bar 1's low, closes above bar 1's close. There is my entry at 36.90. My emergency stop, of course, is 2 ATRs below. My end of day stop on a V1 or V2 is a close below halfway the washout bar. You can see this is the pink line that I have here if I got a close below. Next week, tested that, closed above. Tested that, closed above. Tested that, closed above. Last week, 2 weeks ago, tested it, closed above. Kept me in the trade. But we had Walgreens had some bad news with something with California and some prescription things, so forth. That heavily affected WBA. Not every trade works, unfortunately, right? We'd all be billionaires if it did, but I did have to get out of this trade here. There were no profits in here whatsoever. Unfortunately, it just moved sideways. But then Friday, we kind of gave up the ghost, had a close below halfway the washout bar, took a 10.67% loss. Pretty big, right? But it's not like I lost 10.67% of my capital. Remember, if you position size with that hypothetical $100,000 account, if you position size correctly, getting down here to your emergency stop, you would have only lost 1%. Doesn't matter how much the stock moved, right? So didn't get to my emergency stop, so I lost 1% of total capital. Want to make that clear. Somebody said, oh, you lost 10.67. Does that mean you lost 10.67% of your account? No, of course not, because I position sized correctly using the 2 ATR, right? So, but anyway, still, percentage-wise, big loss on this, but as far as percentage of capital, not too bad, less than 1%, even with a 10.67% move down. AMD. All right, here we go, AMD. I bought AMD back on the 24th of February with this. We had a nice move up. We had a bounce at the 200-week moving average. I like higher low bounces, higher low anything. Got long 77.20 position size correctly. Put my emergency stop 2 ATRs below. My end of week stop is simply a close below the 200. Next week moved up, took a little profits. This last week moved up nicely, took some more profits off near the highs. Right? If you use my approach of taking partial profits off, you will always get something near the high. That's just baked into the cake of the math and how this works. But glad I took profits off at a higher level here. This particular trade currently on the remaining shares that I have up 6.65%. AMD, of course, came down with the rest of the market, but it's been relatively strong, which I'm glad. So up 6.65% on the weekly AMD trade. UNG, oof, well, this one has been interesting. I did take UNG on the weekly. UNG is natural gas with a under 30, over 30, plus a V1 entry trigger, plus a rejection of the negative third ATR channel. Got long 849. Next week up, had a huge week up, thankfully, percentage-wise. And again, I took some profits off while I had them. It's very, very important. Last week, down 18.62%. So down on the trade, currently 5.35%. But again, do you see why taking the partial profits when you have them is very, very important? And I'm very glad that I did that. Now, where is my end of day stop? Well, I took the trade because under 30, over 30. Therefore, if next week on Friday it closes under 30 RSI, I will just get out of the trade. If it gets to my emergency stop, of course, I will get out of the trade whenever that happens. If it moves up next week, of course, I will take partial profits. And again, I teach this all in my one-on-one course. It's very important. I think you're getting the idea because I've mentioned it about 87 and a half times. But this week really shows why it is important to take partial profits when you have them, at least in my opinion. 1.5 ATR trailing stop level up here. Still have not got there, so still not in trailing stop mode. So last week or the week before, took partial profits when I had them, moved back down the remaining shares down 5.35%, but still holding my end of week stop 30 RSI. So I will stay bullish until UNG closes under the 30 RSI, or unless it gets to my emergency stop, or if it moves up again, as always, I will take partial profits. Pfizer. Well, Pfizer just did not work out. Took this trade back on the 3rd of March. Under 30, over 30, rejection of the negative third ATR channel. Looks really good to me, but just didn't work out. Got long here at 41.03. Placed my emergency stop 2 ATRs below. My end of week stop is simply a close under the 30 RSI. And you can see the RSI level here is 28.91. So got out of the trade for a 4.11% loss. Amazon. Different trading approach here. This is a higher low V1 or V2. In this case, it was a higher low V1. We closed below the negative 1 ATR channel. We rallied into the value zone. We pulled back, and then we triggered a V1. Here is bar 1. Here is bar 2. Bar 2 goes under bar 1's low, closes above bar 1's close. Position size correctly. Place my 2 ATR emergency stop below. Where's my end of day stop? Or my end of week stop in this case. End of week stop is simply a close below halfway of the washout bar. That was last week's bar. This is the pink line. And you can see it did close below halfway, got out for a 4.42% loss on Amazon. And then Tesla, I did enter Tesla on Friday. If you've been watching these podcasts over the last couple weeks, I have mentioned, hey, I would love to buy Tesla if and only if we have a pullback to the 200-week moving average. We had here, we closed under, closed over, continued to move up nicely, but I was not going to chase here. I like higher low. Anything's better than lower lows. This is a higher low. We went under the 200 temporarily during the week and closed back above. This is higher than this low, right? People that bought down here as it moved up, really great trade, but as it started to get weak, they are going to get out of the shares, and this is what caused this move down. But this gives me a great risk to reward ratio. Got long on Friday at 173 even. Position size, taking my maximum allowed loss, dividing by the value of the 2 ATR, because this is a weekly trade. That shows me how many shares to buy. I place my emergency stop way down here, 2 ATRs below. Where's my end of week stop? Just simply a close below the 200. Closes 1 penny under the 200 next week. I am out. On the upside, I place my 1.5 ATR trailing stop level above here. Once I get to there, then I go into trailing stop mode. So got long here, 173. It's 173.44, so slightly up on the trade. So those are the trades, everyone, both the weeklies and the dailies. Tough week. Glad I had some shorts, but most importantly, I guess really what the point I want to make here is why it's so important to take partial profits on the way up. Because if you get a week like this, you are so glad that you took some profits and mitigated the losses that happen on a big down week like this. All right, let's do a little trader psychology. This is from my very good friend Ava and former student, but we've become such good friends over the years, and one of the best traders that I know, honestly. How much she studies about trading and the work that she puts in is unreal. Please follow Ava at Presence Trades on Twitter. She always posts great information. I think you will really benefit from reading it. And again, Ava is a person in this world that I respect immensely. Her trading, just her view on life. And I saw this, I was like, this is perfect for trader psychology. Nothing in the market or in life is ever for sure. That's for sure. All we can do is take chances when the probabilities are in our favor and the risk is well defined. Then accept any outcome in advance and leave the rest up to the universe. Well, that is true in life, and it is also true in trading. When people say, hey, give me a quick overview of how you trade. Well, I look for support. Okay, I look for support at major levels like the 200, the 250, the 300 moving average, or the 30 RSI. I look for support on the higher time frame as well to increase my chances. I position size correctly using the current volatility of the market. I place my emergency stop. I know where my end of day stop is. Gives me a good risk to reward ratio. Trading always comes down to risk to rewards at major support levels with confluences on multiple time frames, and then having a plan to having a process regardless of whether it goes up or goes down. And so that's all you can do. Position size at that support level. It's not always going to work for you, but if it doesn't work, getting out quick. And this is what Ava was saying. Nothing in the market or life is ever for sure. All we can do is take chances when the probabilities are in our favor and the risk is well defined. Well, basing it off of a 250, 300, or a 250 or 30 RSI, when you have those combination of signals on multiple time frames, does put the risk in your favor. It's not always going to work, but it does put the risk of the trade in your favor. So if you're wrong small, and if you're right, you can be right big. And that's the calculus. That's the math of trading. Buying at support, good risk to reward ratio, position sizing correctly, letting the markets do its thing, and knowing exactly what you're going to do. So all we can do is take chances when the probabilities are in our favor. And the probabilities are in your favor if you're at support and confluence of time frames and signals on multiple time frames, and the risk is well defined. I know exactly what the risk is, just like on the Tesla trade. I know exactly what the risk is if it's closed under 200, just out. Then accept any outcome in advance and leave the rest up to the universe. Well, that's the tougher part, accepting the outcome. They're not always going to win. We don't make money every week. We don't make money every day. We just have to accept that we put ourselves in the position with a good risk reward ratio. The probabilities were in our favor, but they're not always going to work that way. It's the same with Las Vegas or casinos. Every game, they have a mathematical edge. It doesn't mean they win every hand. They could lose 20 hands in a row. Do you think they get concerned? No, because they know in the long run the math is going to work for them with their edge. It's the same in trading. So thank you very much, Ava. Really good reminder. And please follow Ava at Presence Trades. She has great setups. She has great analysis of the market, has great sayings about life outside of trading. And I think you'll be very happy you did. So thank you very much, Ave. Okay. Before we start taking a look at potential trades for next week, just always quickly want to do a poem for my good friend Frank. You can follow Frank at FrankOD over on Twitter. Always great poem, always pertinent to what's going on. Today's market poem: no one is immune from a panic. Mindsets and markets can pick up a fearful dynamic. Traders must be flexible and adjust when sentiment gets manic. It doesn't take much to make stocks feel like the chairs on the Titanic. Well, he's obviously referring to last week and everything that's going on with SBV, but it's true. Sentiment is very important in the market, either positive or negative. And last week we had a lot of negative sentiment that quickly spread through. So how do you deal with this? What do you do? Do you wait until the sentiment's good again? No. In my case, I use the technicals to tell me. I can't see the future. I don't know how this is all going to play out, but I know the truth of any stock price is in the charts. And if they're holding a level, I don't care if the news is horribly bad. If it's holding the level, I'm in. If the news is good and it loses the level, then I'm out. That's all there is to it. You have to have a plan. You have to have a plan on what you're going to do. And in my experience of 28 years, following the technicals is always, in the long run, the right way to go. So one more time. No one is immune from a panic. Mindsets and markets can pick up a fearful dynamic. That's exactly what happened last week. Traders must be flexible and adjust when sentiment gets manic. It does not take much to make stocks feel like chairs on the Titanic. Last week felt like the Titanic. So thank you, Frank. Appreciate that. Please follow Frank over at FrancoD. All right. So as I mentioned, I have gone down through my master watch list looking for potential setups next week on the dailies. I'm going to do the dailies first, and then we'll get to the weekly bars. I really, as I mentioned before, I really do like weekly bars. Over my career, I've had the largest percentage gains both on weekly and monthly bars. Not that I can't do it on daily bars, but of course the moves on weekly are larger, and so I really do like weekly trades, weekly setups. But I also like daily trades, and let's take a look what I'm looking for next week. Again, it's not going to be something that right now it's time to buy. It's either going to have to go up or it's either going to have to go down, whatever markets we're looking at here. Here is Apple for next week. Oh, this is weekly bars. Let's go to daily bars. Okay. Well, I am looking next week at the 200-day moving average. This is a significant level of support, especially on a stock as large as Apple. Drew the line here at the 200. I'm looking next week for some kind of bounce at the 200, some kind of intraday rejection where during a day it goes below the 200, rejects the level, closes back over, or we could actually close under and then close back over as well. So one of those three scenarios next week having to do with the 200. Now, I mentioned earlier that it's important to look at multiple time frames. I want to see buyers not only coming in at the daily, but some kind of level on the weekly being rejected. Okay, so I drew the line here at the 200 on the daily. Let's go to the weekly and see if there are any confirming signals at the level on the daily. Remember, this line here is the 200 at the daily. Let's go to the weekly, see if there are any confluence of signals. Well, see the dotted line? This is the 50-week moving average. Well, that's a level of support. Definitely a level of support. And do you see how the 200-day, which is the line here on the daily, right? If you see this, oh, no, I'm sorry. Not the 50, the 10. Here is the 10 EMA on the weekly. This is a level of support. Well, the line on the daily of the 200 lines up nicely with the 10 there. So there's a multiple confluence of support. It doesn't mean it has to hold this, but I'm trying to stack the odds in my favor by going, are there going to, okay, there could be buyers coming in at the 200. If it rejects, it has to show me it rejects. But on the weekly, could there be some buyers on the weekly? Some people just trade weekly bars. They're going to be keying off that level. So I really like this trade, everyone, for next week. It's Apple. I love Apple. I don't have an Apple phone, but I do like Apple as a stock. And this is what I'm looking for. Nice confluence on the weekly at the 10 EMA. Dovetails nicely with the daily at the 200. So next week, a bounce at the 200 will get me long. An intraday rejection of the 200 would get me long, or a close under, close over would get me long on Apple. CCJ, which is Cameco. I really like the 200-day moving average. There's the 250 here, but I like the 200-day moving average here at 2490. If it gets there, I drew the line here, 2490. And let's go over to the weekly and see where that dovetails. Well, on this one, it dovetails with the support of the 50 EMA being below. So I do like Cameco as a company. Some kind of bounce, intra-bar rejection, or close under, close over at the 200 would be my entry. Then I would position size, taking my maximum allowed loss divided by the value of the 2 ATR. That's my emergency stop. My end-of-day stop would simply be a close below the 200-day moving average. And again, the 200 on the daily dovetails nicely with the 50 EMA on the weekly. Etsy. Well, 200-day moving average, we have lost it. Now, if we can get back over the 200-day, that might be interesting for me. We're at a 2967 RSI, closed under 30 RSI. If we can go up next week and close above the 200-day, we will also close above the 30 RSI. That is a great confluence. If you have a under over 200 at the same time you have an under over 30 RSI, it's a very strong signal. It doesn't mean it has to work, but it's a very strong signal with a good risk to reward ratio. Let's look at the multiple time frames. Okay, I drew the line at the 200. Let's look on the weekly. Well, we have the 50-week moving average underneath it. If we do get up over the 200-day moving average on the daily, that means we will have also gotten over the 50-week moving average. So it's a rejection of a level to the downside, both on the daily, with it being over the 200, and a rejection on the weekly being over the 50. So that is what I'm looking for next week on Etsy. MasterCard. All right. Well, MasterCard, we have three important levels here. We have the 300, we have the 250, and we have the 200. I've identified the 250 as kind of my level. That would be a confluence of the 30 RSI, depending on which day and depending how far it goes down. That's always hard to say until it happens, but the 250 is right there. I know exactly where that 250 is. I know it's going to be close to a 30 RSI, so I draw the line at the 250. Where does that dovetail on the daily, on the weekly? Dovetails right at the 50-week moving average. So you see support at the 250 on the daily, dovetails with support of 250 on the daily, dovetails with support at, yes, 50 on the weekly. So multiple levels of support. That's what I'm looking at next week if MasterCard gets down and rejects the 250. If it goes straight up, I'm not going to mess with it. If it goes down through it, I'm not going to mess with it. Also, by the way, we have a double bottom and a bullish divergence going on. Again, this is another strategy that I teach in my one-on-one course. It's great. I learned this from studying one-on-one with Dr. Alexander Elder. Double bottom bullish divergence. Look at this low here. See the low we have? See how deep the red MACD bars are? This means there's a lot of momentum to the downside. Well, we rallied up, got some green MACD bars. Now we are lower than this low, right? Obviously now we are lower than this low, but look at the MACD. It's not as deep as over here, right? This is called a double bottom and a bullish divergence. Dr. Alexander Elder, in his opinion, this is one of the strongest setups in technical analysis, and I would agree. It's very strong. I see them work over and over and over. So confluences of signals, very important. So we have a double bottom bullish divergence. That's a good sign. All that means is this move down here was not as strong as this move down here. The implication is that you're running out of sellers based upon the lack of momentum to the downside from a MACD perspective. And the other implication, if you run out of sellers, you're going to move up. So do we have a double bottom bullish divergence? We certainly do. But Does that mean I just jump in? No, I still need a signal. Well, the signal for me, based on the multiple time frames on MA, would be a rejection next week at the 250. All right. Morgan Stanley. Well, of course, the banking sector got hit last week. I have identified the level that I'm interested in on Morgan Stanley down here at the 200-day moving average, about 85.46, 85.50. Now, that's a long ways away. So that's fine. So if it gets there, it gets there, and I take the trade. If it doesn't get there, then I don't take the trade and I take something else. But why am I looking at this 200-day moving average level? Drew the line here. How does that dovetail on the weekly? It dovetails nicely on the weekly with support at this previous low here, and also with the support of the 50 SMA below it. So don't know if it's going to get there, but if it does get there, it makes sense for me to buy it. It gives me the ability to construct a good trade based upon support on multiple time frames, and also at a key level, a line in the sand level, where if it bounces the 200, I'm in. If it rejects the 200, if it closes under 200, closes back over, I'm in. Or if it intraday rejects it and closes back over, I'm in. It tells me exactly, it gives me a perfect line in the sand. Above it, I'm in. Below it, I'm out. If it moves up, I take partial profits. If it gets to trailing stop levels, and all that kicks into place. And again, this is what I teach in my one-on-one course. And by the way, I think, learning something one-on-one is the best way, whether you're playing tennis or playing the violin or trading. It's always a nice thing. And I think the most ideal to have a teacher that you can work with one-on-one. Ask as many possible questions as you can. I take you through a lot during this course. We run a lot of simulations. We do all sorts of simulations on multiple time frames, random stocks, random time frames, so that I really know that you have it. And, it's very important to me that my students succeed. Extremely important. It's important to me. It's important to my brand. And I genuinely want my students to succeed. So, I always bring 110% when I teach my lessons. And so you should consider it. You will learn a good skill. So Morgan Stanley, next week, rejection of the 200-day moving average is what I'm looking for. That dovetails nicely on the weekly with the support of the 50 below it. Microsoft, well, I just got out of Microsoft for a loss, but if we get a close back above the 200-day moving average, then it's a rejection of the 200-day moving average, and it would be a higher low rejection of the 200. And remember, I always like higher lows much better than lower lows. So if it closes above, potentially going to take the trade. And by the way, if we have a good week next week, all 6 of these 10 symbols could trigger. Does that mean I'm going to take them all? Of course not. What I like to do every day is even if I have 7 great candidates at the end of the day, they've all triggered signals, it all makes sense, I am going to narrow it down to the number 1. And how do I do that? Well, look at the multiple time frames. I almost added up how many signals on the daily, how many signals on the weekly, what's the risk to reward ratio, and I have to put it all together, go through it with a fine-tooth comb, and look for the best one of the day. But over the last 28 years, looking for the very best trade of the day is the important one. So next week, if all these signals, just want to be clear, I'm not going to get into all of these. I'm going to pick the best one of the day. So Microsoft, it may just barely poke its head over the 200. Maybe these other positions I have all trigger, but they've triggered way too high. Doesn't give me a good risk to reward ratio. Then I'll probably take Microsoft. I'll take the one that has a good risk to reward ratio, everything else being equal. So Microsoft close over the 200 would definitely be a potential. Netflix. Well, Netflix has really come down, my gosh. And look, I've identified the 200. It's a long ways away. It's 30 points away, but it doesn't mean it can't get there, right? In this market, it definitely could get there. That would be an amazing place to take a trade on Netflix if it gets there. I drew the line. Let's look at the weekly. That dovetails perfectly with the 50-week moving average. You see that? I want support on multiple levels. So the 200 on Netflix dovetails with the 50 on weekly. Probably be some buyers coming in here at the weekly. At the same time, we have buyers coming here on the daily. That's 2 groups of buyers potentially, and it gives you a good risk to reward ratio. It gives you better chance to have a profitable trade, and that's all we can do. So if Netflix gets down there, I will certainly consider buying it. If it doesn't get there, I'll just move on to another market. Philip Morris, 200-day moving average coming into sight. Same rationale. 200-day moving average on the daily dovetails with the 50-week moving average and the 50 EMA on the weekly. So that's also a potential. Qs, of course. We close below the 200-day moving average. Close back over the 200. I would also consider getting long Qs again. Of course, I just had the trade, right? Had a profitable trade. The remaining shares I got out because I hit my end of day stop, but we could close back over the 200-day moving average. And last but not least is the SPY, S&P 500. What I'm really looking for is a deep dip buy of an under 30, over 30, somewhere down here around 379.60. Drew the line at where the 30 RSI is going to be. Looking at the daily, that dovetails nicely with the -1 ATR channel. So multiple confluences. So yes, it could close back above the 200-day moving average. That would also be a potential, but my ideal on the S&P would be a deep dip buy of an under 30, over 30. So just quick recap on the daily. Apple, I'm looking for some kind of rejection next week of the 200. Cameco, looking for some kind of rejection of the 200. Etsy, looking for a close over the 200. And by default would be over the 30 RSI. MasterCard, looking for a rejection of the 250. Morgan Stanley, looking for some kind of rejection of the 200. Microsoft, looking for a close above the 200 to the upside. Netflix, rejection of the 200. Philip Morris, rejection of the 200. Qs, close back over the 200. And again, SPY, rejection of the 30 RSI. All right, here we go to the weeklies. Now remember, weekly bars close on Friday, so I would make my decision on the Friday for next week. Starting off with Dow Jones Industrial. Well, 200 week moving average down here at about 304.90. I drew the line. How does that dovetail on the daily? Dovetails with the 50 EMA and SMA below as support, so that makes sense. So looking for Dow Jones DIA, if and only if we come down, have some kind of bounce, intraday rejection, or close back under, back over on the Dow. So that's what I'm looking for next week. If we continue the move down, that's a good level of support. You can see back in the past, the 200 did act as the support before we had the move back up. Will it do it again? I don't know. Certainly don't know, but it does. When you look back in the past at a level that was supported in the past, it's more likely that it will be supported in the future, but it doesn't mean it has to. But that's what I'm looking for. Again, 200-week moving average. If I look at the higher time frame, in this case on the monthly, dovetails with the 50 EMA and SMA above as support. Google. All right. 2 levels of support on Google that I am looking for next week. The 250 and also the 300 SMA. Now, I took this trade on Google last time. It rejected the 250 and had a beautiful trade. Good thing I got out right before earnings. That's always something that I do. I don't hold through earnings, but yeah, got in here at approximately $87. Got out of the rest of the shares up here at 107. Got out because of earnings, and good thing that I did. But it did reject. It has held support at the 250 in the past. So that's why I am also looking for the 250 again on the weekly. Or if it goes through that, 300 would also be a good level. Home Depot. 200 right there. Makes sense, right? 200 here at 271.10. Let's see how that dovetails on the higher time frame. Support of the 50 and the 50 SMA below. So a lot of good potentials. If we continue this down move next week, a lot of good potentials both on the daily and the weekly time frame. So Home Depot would be interested at the 200. And again, if these all trigger on Friday, it doesn't mean I'm going to go, oh, now all 10 of these triggered, so I'm going to get in. No, I'm going to pick the best one. Confluences, signals, on multiple time frames, have to factor in the risk to reward. INDA, India, well, we did bounce last week at the 200. We came down, we held it. This is another interesting market here. If next week we get a rejection of the 200 week moving average, let's see what that looks like on the monthly. Well, on the monthly, we have support of the 50-month below us, so that makes sense. That's also a potential. Johnson & Johnson, 200 right here on the weekly. We're at 31. We're at low 30s. We're at 31.19. 200 would almost certainly dovetail with the rejection of the 30 RSI. If we could get a rejection of the 30 RSI and a rejection of the 200 on the weekly, it would make sense. Let's see where the 200 lines up on the monthly. Has the support of the 50 monthly EMA below it. So that makes a lot of sense. Look at this down move on Johnson & Johnson. My gosh, eventually there will be a level that holds, and maybe it's the 200. So that's what I'll be looking at. Pfizer, of course, I got out of Pfizer. I took the trade last Friday, had to get out this week. We're at a 28.91 RSI. We're below the 200-day moving average. Close back over the 200 would also push the RSI level over the 30 RSI. That would make a lot of sense. Under over 200, under over 30 RSI together is one of the strongest setups. Doesn't mean it has to work, but it certainly stacks the odds in your favor. Drew the line here, 39.60. Let's look at the monthly. Still have support of the 50-month moving average. That makes sense. So that is also a potential with a close back over the 200 and at the same time a close back over the 30 RSI. Qs on the weekly. We've talked about Qs on the daily also, but Qs on the weekly, yes, if we continue to move down, have a rejection at the 200-week moving average, that would be a potential entry. SSO, double leverage. SPY. What I've really identified, yes, the close back over the 200 is potential, but what I've identified is the 250 here. The 250 on the weekly dovetails with halfway. That you can see there's really no discerning moving averages or anything that line up, but that level with the line here lines up with halfway of this big up move. And this is V1, V2 stuff. Again, something that I teach in my one-on-one classes, but that level, 4280, which is the weekly 250, dovetails with halfway of the up move on the bar that we had back here on the 31st of October. So that makes sense to me. Again, just to be clear, what I'm looking for in SSO is next week a rejection of the 250. Walmart, 200 makes a lot of sense there. Don't know if it's going to get there, but if it does, that would be a great risk to reward ratio. I think what I'm saying here, people, is be patient. Be patient. Some of these 200s may come into play next week, right? And don't do anything. For me at least, I'm not going to do anything unless they get to those levels. I love to look at the charts on the weekends and go, oh, this level makes sense on the daily. This level makes sense on the weekly. If it gets there, I'm in. If I'm not, I'm not. And over 28 years, that is what I have found really works. So Walmart at the 200, that dovetails nicely on the monthly. In the value zone, not as many levels on the monthly chart here that make a lot of sense, but still 200 here makes sense on Walmart. And then last but not least, XLF. Well, this is certainly going to be something that people are following, especially with what's going on with the banking industry. 200-week moving average could make some sense here. That dovetails on the monthly with the 50 EMA. So multiple confluence of signal. So real quick recap on DIA, looking for weekly rejection of the 200-week moving average. Alphabet, ideally, I'm looking for a rejection of the 250 or the 300. Home Depot, looking for a rejection of the 200 on the weekly. INDA, looking for a rejection of the 200 weekly. Johnson & Johnson, looking for a rejection of the 200 week. Pfizer, looking for a move back over the 200, which would also move us back over the 30 RSI. Qs continue to move down, bounce, or intra-week rejected the 200. SSO, looking for it to continue to go down, look for rejection of the 250. Walmart, rejection of the 200. And XLF, rejection the 200. So, at the beginning of through this, I've mentioned my one-on-one courses. And listen, if you really want to learn a skill, I will teach you the skill of trading. I will teach you everything that I know, everything that I've learned in the last 28 years. Again, the course is a total of 15 hours, 5 sessions total. Each session's 3 hours. That's where you get your 15 hours. I will teach you step by step everything that I know, all the different trading strategies that I use. The course costs $1,750, but it's worth it. It is so worth it. And I've had so many students that have been said, Greg, it's one of the best things I've ever done. And thank you so much for talking about it. And so, if you are interested, my email is in the link of this YouTube video. All you have to do, send me an email, say, Greg, I'm potentially interested in taking your course. I'll reply and say, great, thanks for saying hi. Let's set up a Skype call. The Skype call is free. It's not a sales call. I just want to learn more about you, your trading challenges, your goals. It's a good time for you to ask me questions about the course. And when we're done, that's it. Then it's up to you. I won't contact you or send you emails or anything like that. If you decide one day, hey, I want to take that course with Greg, I want to learn how to trade, then just email me back, contact me and say, Greg, I'm ready to go. We'll set up a time and a place and we'll start, and you will be glad that you did. Now, if you like online trading courses, I have a great course that's very, very affordable on udemy.com, and the link's in the description. It's called the Deep Dip Buy Stock Trading Strategy. Now, it's not as good as taking the one-on-one, clearly, because I teach you 4 other approaches, but for the money, it only costs $12 or $15 for that entire course. Then there's 9.5 hours of video, there's 26 videos total, there's 15 study guides, and in that course, I do teach you step by step how to trade the Deep Dip Buy Stock Trading Strategy. I have sold so many of those courses. I have had such good feedback and review from people all over the world, and it's a great place to start in regards to the money with the Udemy course. Only $12 or $15 depending on the day. So the link's in the description. If you like today's podcast, I would really appreciate it if you could hit the thumbs up button. It helps to build the channel, helps keep the channel around, lets YouTube know that there's some valuable content here. And fourth, and most importantly, please try to go out and do something nice for someone today. If we all did one nice thing for another human being, this world would just be a better place, wouldn't it? It just makes sense. It doesn't have to be anything big. Just hold the door open for somebody, lend them an ear, give them a smile. It's going to make their day. And you'll be happy if someone does it for you if you're having a day. And the last thing, in addition to doing one nice thing for a human, if you could do one nice thing for an animal, that would be the best. And animals appreciate acts of kindness just like you and I do. And so one nice thing for an animal, one nice thing for a human, that's all I ask, and maybe a thumbs up on the video. It would all make the world a better place. So I appreciate you watching the video. I hope that it will be helpful for you. I hope you have a good weekend. Please be careful next week. The market's very volatile. Use your signals. Stick with your plan. If you have any comments or questions about anything, feel free to put them in the comment section. I'll do my best to reply. But again, thank you for investing the time. Hope it was helpful, and I hope you have a good weekend, and God willing, I will see you next week as well. All right, take care, everyone. And on the way out here, I have to run the U.S. legal disclaimer. Thanks again. Bye-bye.
U.S. government required disclaimer. Stock options and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.